Hello and welcome to this week's episode for Spy Trader Now. Today is November 25th, 2023. I am your host. My name is Ken, and our model portfolio is up 13.52% year to date. Our color guard for our stock market strength indicator is yellow. And what we do here is we try to beat the returns of the S&P 500 buy and hold investor. And we do that with investment grade capital, not trading capital, in our model portfolio. Even though it's called Spy Trader Now and we do trade it, we do it conservatively. And so we use investment grade capital, and we start off the year with $100,000 and we build our capital from there with the goal of trying to beat their return on a percentage basis. So far this year, we are not accomplishing that goal. It's been a challenging year with my strategy, with this strategy, I should say, with trying to beat the returns of the buy and hold investor. The risks are too great for me to want to take extra long positions during this particular market. As indicated by my yellow signal strength, I'll show you how I derive at this signal later on in the video. So that's where we stand so far. Basically, I'm going to recap this in one sentence. This week is pretty much the same presentation as last week, so I'm going to go through it very briefly because there's no reason to do a deep dive every single week over the same content. So I'm in the same position. You'll see at the end of this presentation what my views are on this current market and where I think we're going. Here are some past returns for Spy Trader Now's model portfolio. Last week, the S&P 500 gained 1%. These are candlesticks on a weekly chart, and you can see that we are coming up against a resistance line, this red line right here. I'm going to do a deep dive in the charts later on, but as long as we're at this slide, I want to explain to you that we are at a resistance point right here, and then we come across the all-time high, which is right here. There's about 3.4% between where we're at now and the all-time high. I made no trades during last week. So here are some of the trades that I've made in 2023. If you want to see all my trades going back 3 years, you can head over to this website. There'll be a link down below. There will be a link down below in the description for everything that I am presenting to you. So if you want to explore anything, you are more than welcome to do so. I have 2 open positions. On my Excel chart, I've got the cells identified by yellow, meaning that they're not closed out. That's why they don't have sell dates and so forth. Here is the equity curve for our model portfolio for 2023 year to date. Here is the equity curve for the buy and hold investor for the same time period, 2023 year to date. Here are the 2 equity curves combined. So we want to compare our model portfolio against the benchmark, which is the S&P 500 buy and hold investor, symbol SPY. ETF. That's an electronically traded fund. Now, I've been somewhat conservative as of after this great bull run that we both portfolios experienced. But then I took my portfolio expecting a pullback. That pullback never happened. The S&P 500 has continued to advance pretty good, very impressively, quite honestly, as if you're in a bear market and this is a bull run right now during a bear market. So because it's so impressively so vertical. Here's the Fed Chair, Jerome Powell. The next announcement for interest rates from the FOMC will be December 13th. We have about 2.5 weeks to go to see whether we're going to skip or have a 25 basis point rate hike. All right, now we're looking at the presidential election cycle theory. Depending upon the year of the election, will determine historical rates of return for the S&P 500, and here are historical rates of return for the NASDAQ 100, symbol QQQ. Let's focus on the S&P 500 because that's what this channel is all about. Now, we're in the third year of President Biden's term. Historically, that average is 16.3%. The S&P buy and hold investor is up about 19%, giving room for about a 3% pullback between now and the end of the year to meet the historical average. Now we're looking at things from the bond market outlook. We still have that inverted, nasty yield curve, not good for equities. We still have a rising interest rates, not good for equity investors. Now we're looking at valuation from two different sources. One source is CMV. Their link is here and down below in the description. They say we're overvalued going by the price per earnings ratio. VectorVest, which is another stock service, link here and in the description, well, they say that we are currently at value, and they have a buy recommendation for SPY. We do have shares of SPY. We're currently holding 200 shares, but I have an in-the-money covered call, which is not allowing us to totally get good appreciation while the market is going up, because we've capped our appreciation due to the in-the-money covered call. Now, if this market is going to experience the pullback that I'm expecting, then at some point we're going to buy to close our covered call. And then as the market advances again, we will take advantage of being long without having that capped in the money covered call. Now we're looking at CNN Business Fear and Greed, and we are at greed, almost getting towards extreme greed. And we are definitely increasing our greed from 1 week ago, 58, today 68. There's our friend Warren Buffett. Now we're looking at things from a seasonality standpoint, and I added in an additional chart this week, or information I should say, about the average annual returns for the S&P 500 just doing a Google search. If you want to go back 30 years, the average annual return is 7.52%. We are currently in the month of November for 2023. This month, we have returned an enormous 8.87% on the index of the S&P 500. Look at this impressive candle. It is unbelievable. Look at all the other candles during this year. This particular candle is just incredible. So right now, the S&P 500 buy and hold investor is up 18.91%. The average going back 30 years is 7.52%. The odds favor that we are going to have a pullback between now and the end of this year. Still making good returns, but I don't think the S&P is going to pump out that 19% return. At least judging from this information and the historical averages, it does not seem likely. All right, now we are looking at the long-term. This is a monthly chart going back 20 years, S&P 500, bull run 2009 all the way to 2020. Then we had a downward trending channel, broke out above it, and never looked back. So we are in a bullish stance as long as we stay above this line, this support line here, and as if the MACD stays positive. Now the MACD wanted to come down. It almost kissed its signal line, but it did not. It bounced off and it started to advance. If this market has that pullback, depending upon what that pullback looks like, if that's a nasty pullback, that could come back down and cross underneath this MACD. So we're going to watch that. Now we're looking at weekly chart S&P going back 5 years. And this is a chart that I showed you earlier in the presentation, but now we see the MACD, which actually looks very bullish, with a histogram showing bullishness and going positive above the zero line, slow stochastics reaching above 80. So this particular chart looks bullish, but you're at a resistance point here, which is of concern. Now we're looking at a 6-month chart, daily candlestick. Look at that impressive run, very short period of time. Unbelievable. unsustainable rate of growth. This is, well, it's already started to come out of its channel as of Friday's trading. So we just started to get some sideways action here as of Friday, but it just seems like we should come down, and we have an in the money covered call with the 420 strike. And 420 takes you all the way down here, which is way, way, way down. We bought it on this candlestick. Now, in retrospect, looking at the chart, that was a bad trade for me to make. I should not have taken that covered call. I should have just stayed long the S&P 500, but I wanted to give myself downside protection. So when this market does correct, we're going to buy to close that covered call, and we will buy to close it for less money than what we paid for it, as long as it closes below, the S&P 500 gets below this candlestick right here. If we get below that candlestick, it's a guarantee that we're going to make money on that trade. If it doesn't, we're at least making money on the stock, but we could lose money on the trade. So all in all, it'll kind of wash out. So we're in a protected position. We're just capped on our gains. And with the market advancing like that, we're not participating. Now we're looking at a ratio chart for the NASDAQ 100 against the S&P 500. And normally what you want to do is you want to see the NASDAQ 100 leading during bull markets over the S&P 500. And normally that's the case. Now the NASDAQ 100 is in lime green. The S&P 500 is in dark blue. And you'll see that normally when you've got good advances on the NASDAQ 100, the S&P 500 also does advance. So, but right now what you see here is on the MACD, you see the MACD is just getting ready to, it's right at the signal line, ready to come down. The histogram showing that this market has lost momentum. Now, we're looking at another ratio chart. The equal weighted RSP against the normally cap weighted S&P, which is symbol SPY. The ratio chart is in black and red. Fallen off of a cliff. This is going back 20 years of data, tons of information here. And we have fallen off a cliff, but the market has not, like it did the past two times. I would hate to be long the S&P 500 and experience that drop. Are we going to get that drop? It is possible. It is possible that you could get that drop in 2024 with this inverted yield curve and the fact that it hasn't dropped like it has in the past two times in the past 20 years. These are concerning issues. Now look at your fear index. This is the VIX volatility index. We are at rock bottom, ultra low range, and we are at the bottom, the absolute rock bottom of that range, 12.46. The S&P 500, if it does this, and if the VIX comes up and does this, the S&P 500, which is in dark blue, is going to go from here down to here. So we're going to have a correction in there. Look at your MACD on the VIX. You can see the histogram is showing that it's lost its downward momentum. This has come down to a very low territory. It's practically, very rarely does it see this particular type of low level in the MACD. So if this S&P 500 begins to come down, this is going to begin to pop up. Now we're looking at the Think or Swim platform, S&P 500 1-year chart, and we have standard deviations. Now with standard deviations, and there's some information about standard deviations right here. You got the +2, -2 in gold, +1, -1 in pink. The 200-day moving average in black, the 50-day moving average in solid green. The dashed green line here is the regression line, which is halfway between all the standard deviation lines. Right now on the 1-year chart, we are at 0.3 standard deviation. So this market can go in either direction. The MACD on this chart is very high, and it's only been this high twice. One time here and one time here. One time here, correction. The other time here, small correction, but somewhat of a correction. Now we're looking at the same chart, but now we're going back 6 months instead of a year. notice how the slant or slope of the standard deviation lines is going negative now. They're about flat, really. But compared to 1 year's chart where they were advancing, now we are flat to slightly negative. You can see on the 50-day how we are definitely sloping down here clearly. Look at this unbelievable bull run that we've had from the -2 standard deviation almost touching the +2 standard deviation on this chart. Now we're looking at the same information, except now we're only going back 3 months. You can see that we hit the -2 and we just about nicked the +2 standard deviation. I put in here your sell zone, and when this comes down to about the halfway point, which is about where the last time it peaked and then came down, I'm assuming we're going to find some type of support right about here. That would be a reasonable pullback. And if the market does show signs that it is going to hold there, we'd want to take and buy to close our covered call, or in the money covered call. We may even take on some long calls, so that way when this market comes back up to advance, if it's going to, we would be able to participate in more of a bullish stance at that point in time. But right now, I'm not going to take those positions because of where we stand on this chart. Now, we have a yellow signal strength indicator. And the S&P 500, which is up here, is made up of 11 sectors. Those 11 sectors are right here. The ETFs for those sectors are right here. And I have information here or data pertaining to the strength of each one of these sectors. There's only 2 sectors that are carrying this market right now. Those are the communication and technology sectors. As a matter of fact, I do covered calls with a separate portfolio just on covered calls. I want a 3 or higher just to participate in covered calls. There's only 2 ETFs out of the 11 sectors that I would want to do that with. And because of how overbought they are, I don't even want to do that right now, because if you look at the charts on those, we're at the +2 standard deviations on these 2 ETFs. So not good for covered call writing, because I'm expecting a pullback. Now up here we're looking at asset classes. Now on asset classes, by the way, last week we were at 33. This week we're at 40%. So this market is increasing. Once we hit 51%, this is going to go from yellow to green. But we're not there yet. We're still in the yellow. Okay, now on asset classes, we have NASDAQ 100 doing pretty well. And we also have gold, which is a flight to safety. Doing well. That's got a 5 here. And if you look at the other ones, the other asset classes are not doing so great. Although we did improve from 35% last week to 48% this week. So that's where we stand with asset classes. Now we're looking at a chart of the bonds, TNX, 10-year bonds. And so the candlesticks are your bonds. See that gap right there? I kind of have an expectation that that gap is going to get filled. The MACD has clearly lost its momentum on this downward trajectory, and you can see the MACD histogram going in the opposite direction. We've bottom curled and getting ready to come up and cross its signal line. Slow stochastics already above the signal line, getting ready to cross above 20. If this thing starts heading north, that means that this is also heading north. And if that closes the gap, your S&P 500 is in dark blue. Guess what the S&P 500 is going to do during that time frame? This thing is going to come crashing down like it did from here to here. I have just given you a ton of information in this video. Now comes the critical thinking. What are you going to do with that information? Well, pretty much I told you what I'm going to do, and I also have it outlined right here. November 25th, 2023, the market summation, according to me, your friendly host with SPY Trader Now, Ken, on Friday, 11/13/23, I rolled out my in the money covered calls for a $3 credit. 305. And I'm expecting downward to sideways action over the next week or so. I can't say exactly when, because the market's going to do whatever it wants to do whenever it wants to do it. We do want to go long, even though we have a yellow signal. But we don't want to enter more longs at this very high, elevated, close to the +2 standard deviation level. My plan is to buy to close my covered call in the money covered call positions when SPY reaches some level of support on the 3-month chart at the regression line or below, showing me that there's some value there for me to buy long. The regression line is that dashed green line on the standard deviation chart. I am still concerned about this market until the slope of the 50-day simple moving average is flat or positive over a 20 trading day time frame, which is not much, just 20 trading days. So this market has been a rally and what I think a bear market. And we are trading above the 50. This all has to correct to show me that we're truly now changing from the bear market to the bull market. I'll see all of that taking place with my standard deviations, the slope of the 50, and I'm monitoring everything to make sure that I'm taking on the positions appropriately and putting the correct amount of risk reward ratio. We are in a good position as we are holding $17,620 in cash in the model portfolio. That concludes this video. I hope you got some valuable information out of this video. If you have not done so already, hit that subscribe button, ring that bell, help me, and smash that like button down right now. I thank you and I wish you good trading.